Smart investment is about managing your portfolio properly. Good investment with poor portfolio structure equals bad performance. So today we shall be talking about portfolio management. First of all, what is portfolio? Portfolio simply means a collection of investments like stocks, ETFs, crypto, bonds, real estate, mutual funds, treasury bills, and cash. So what is actually portfolio management? Portfolio management is simply the process of choosing your investments, organizing them, monitoring them, and adjusting them from time to time to achieve your financial goals while you still manage risk. So this is a very important aspect of investments. Is you don't just buy investments and keep them and keep looking at them. If they are not managed properly, then you're getting it wrong. So there are core principles of portfolio management, and there are about 5 of them. When you talk about first thing to do when you want to create a portfolio for yourself is to determine what your investment goal is. Are you trying to establish this portfolio for your retirement? Is it for acquiring a building? Is it for maybe investing in yourself academically? Is it just, first of all, sit down and determine what is this portfolio for? The investment goal is the first stage of, if you haven't decided what to do with this portfolio, in the long run, you may be involved in things that are not really aligned with your goal. So the first stage is determine what the investment goal is. After you have done that, the next stage is risk management. Assessing the level of risk that you can take. Am I an aggressive risk taker? Am I a conservative risk taker? When you have determined this, then it allows you to invest into investments that align with your risk tolerance or your risk profile. Because this is important. If you're someone who your emotions always get over you, then you can be investing in things that have high risk. But for people who are able to manage risk in their own way aggressively, then they can invest in things that are highly risky but gives higher returns. So this is a very critical stage of portfolio management where you are able to determine the kind of risk taker you are, and it also helps you a lot to know your time in the market. If you're an aggressive risk taker, you will be able to know, do I want to invest in this particular investment in a short term, or will it be a long-term thing? So the first stage, investment goal, and then determining the type of risk taker you are, and being able to establish how to manage those risks. Then the third stage in portfolio management is asset allocation. At this point, you are now able to decide the kind of assets you will have in your portfolio. Do I want stocks? Do I want ETFs? Do I want mutual funds? Do I want treasury bills? What do I really want? This also is very important because it has to align with your investment goals. If you are still in your growth stage, then stocks and ETFs are for you. If you're in your retirement age, then you might be considering more of bonds and also treasury bills, things that have steady stability and in income flow. So this is the reason you have made all the first decisions, because it now helps you to allocate funds properly, into different investments. And the next stage here is diversification. Diversification is very important. Even when you have allocated your assets into different asset classes, it is important that you spread your risk. If you are highly invested in just one particular sector like the consumer goods or like the tech goods, and then it means that when there is a failure in that sector, your portfolio is most likely to fail. But if you are able to diversify accurately, like 50% in the healthcare, like some percentage in the healthcare, some percentage in the banking sector, some percentages in crypto, some percentages in stock, even in real estate. When you are able to diversify percentages, you are spreading your risk. So in that case, it is really, you are able to manage whatever goes on in the market. Don't forget, the market goes up and comes down. It's a cyclic movement. So there is no guarantee that it has to be upward movement all the time. And so knowing that makes you it makes you able to diversify across sectors, even across regions. It doesn't have to be Nigeria all the time. It doesn't have to be Australia all the time. It doesn't have to be US all the time. And you just have to manage it and allocate your assets properly across sectors, across industries, across regions too. Okay, so diversification is very important. It helps you to manage your risk. Also, the last but very important is monitoring and rebalancing. You have to keep monitoring your portfolio, and at a time when you think your portfolio has grown above your financial goal, or it's no longer aligning with your financial goal, then that is the point, the time to do what? To rebalance. Take out some percentages from those who have gone above the percentages you want them to be, and reallocate them to the other investments. In this case, you're monitoring your portfolio properly, and you're rebalancing properly. This could be done depending on what strategy you're using. And this leads me to the several portfolio management strategies that we have. There are different portfolio strategies depending on the metrics you want to use. If you want to use a management style metrics, we have passive portfolio management, we have active portfolio management. Passive is usually good for long-term investors, because here you don't need to be going in and out of the market all the time. You just research for good companies, and then you invest in them, and you you allow them to perform. Here you are not trying to beat the market, you are just trying to match the market performance. And for active portfolio management, these people want to beat the market, so they go in and out of the market all the time, and this is also very risky, and so it's also not very cost effective, because you keep paying fees because you're going in and you're coming out of the market. So you need to choose, who do I want to be? What style do I want to use, passive or active? For long term, passive has always won, because you don't need to time the market. There's no need timing the market. Time in the market will always beat time in the market. So we also have another strategy that it depends. Here it's about the financial goal. We have growth investing, we have growth investing, we have value investing, we have income investing. A growth investor tries to look for small companies that he feels will expand in future, and then he uses this strategy to invest in them, hoping they will do what? Expand, and his capital will appreciate. Also, a value investor is actually looking for established companies that he believes are still undervalued. So he invests in them and also forgets about it, believing in the long term that the market will realize their value, and it will go up to favor hey, so there's also another one, which is income investing. Income investing here, you mostly look for dividend companies that pay dividends, interest, and investments that give good interest, because you want to be having steady income. Here, people that invest in this are also maybe people in their retirement stage, trying to get money all the time. So you have to determine, what kind of investor am I? What stage am I? How much time do I want to spend in the market? This helps you to choose either of these strategy depending on your financial goal. There's also another strategy, which is about your risk appetite. Am I an aggressive? Do I want to use an aggressive strategy? Do I want to do a conservative strategy? Here, it depends on your risk appetite. You choose which one you can. Aggressive is most times trading. They do trading, go in and out of the market all the time. Conservative, always research for something solid and then wait for it over time to appreciate. We also have another portfolio management strategy. Here it's about risk control, and the first one is diversification, like we have talked extensively about it, trying to diversify across industries, across sectors, and even across regions and countries. And the last one of it is dollar cost averaging. This is a very good strategy technique that wins all the time. It's not about dumping huge amount of money into your investment and leaving it there. No, you could go into huge loss by that. It's about always putting in some amount of money at a designed time. If you have decided that every month I'm going to put 1,000 naira, I'm going to put 1 million naira in this investment, you'll be consistent at that. That is called dollar cost averaging. This helps you to manage risk. It helps you to beat the market, because you're not timing for when it is low or when it is high. You keep going into the market and getting that particular investment that you want. In this case, you are beating the prices, So these things I have told you, there are ways to manage your portfolio, and if you're able to do them, you find out that you are not losing in the market. You will always be winning in the market. And tips for portfolio management success are: start early. When you start early, there's no way the market will beat you. Also, be diversified. Avoid emotions. Don't panic and sell because the market is low. And also, don't FOMO, fear of losing out, because you think this excitement will elude you. If you don't buy it now, you will keep losing in the market. Avoid emotional investment that will drain your portfolio. And don't forget to keep reviewing your portfolio. Don't just establish a portfolio and go to sleep. No, this is another business that you have established, and every business requires constant monitoring and constant reevaluation and rebalancing. So make it a duty to monitor your investment and adjust it always according to your goals and risk tolerance. Again, this is Laureate Insight. Here we make investing simple. We bring education to you. Kindly subscribe, like, comment, share for more insights on how to actually establish a portfolio that wins. Until we meet again, stay peak and remain blessed.